Planning for retirement these days can be challenging. We are facing money problems that didn't exist decades ago. So joining us with some advice is Tim Dern of Hughes Dern Financial Group. Thanks for coming in today. We appreciate it. Always good to talk about this because this applies to every age, doesn't it? So what's different today that we didn't have to deal with before?
Well, back in the 60s and 70s, we saw more guaranteed money. So people would retire somewhere around 65. They had their Social Security, but they also had a company pension. Guaranteed money all the way through their life was easier to plan, was easier to make, decisions because that money was guaranteed. They weren't really thinking about saving for retirement. Today, we see it different. Employers have now switched more to 401k. The onus now more on the person saving. You've got to contribute to these plans. That money is not guaranteed when you retire. You've got to kind of manage that money. And so now you're all about savings for your own retirement when you move in retirement.
Okay, and so this, you have some great tips. So let's start with, okay, where do you begin?
Well, I would say if you have a company 401k plan, that you should start putting money into that plan. We recommend 10 to 15%. If you can handle that, put that money in. If your employer actually matches, that's actually free money that you can get too. And sometimes people want to put the full amount into a 401k. It's about $18,500 a year. You can also save outside of the 401k into a Roth IRA or another just regular traditional IRA, another $5,500. And again, you're building that bucket for retirement so you have more money when it does come time for you to live on that money.
So that Roth, if your company does not have a 401k, is a great alternative.
Sure. And even if your company does have a 401k, you can still also contribute to a Roth. Yeah.
Okay, so this is something interesting that I think a lot of people don't think about. And you say we should all be planning for health care costs.
Yeah, health care, look at how high the health care costs are gotten. Even your own health insurance. I mean, it's just been crazy. We see that becoming even a bigger and bigger expense when you're in retirement. Even though there's Medicare, covers a lot and different things like that, but there's a lot of things that Medicare doesn't cover. So we also talk to people about maybe setting up an HSA account. This is kind of a tax advantage account. You can save money and you don't have to pay tax on it, and you can actually invest that money and grow the money. As long as you're using that money for a qualified medical expense, you won't pay any income tax on that. It'll cover things like trip to the doctor, maybe contact lenses. These are things that Medicare doesn't pay. And then you can use that money anytime you want because it's not like a restricted 401k plan where you don't have to be 70. Right, so as long as you're using that money and using it for a medical expense, it's a nice alternative to help with the health care costs.
And then another important tip that you have for us is deal with your debt because Americans, everyone has debt.
Yeah, this is what nobody likes talking about. I mean, I was thinking back when we were doing some research that back, you think in the 60s and 70s, it was even hard to get a credit card. You couldn't hardly get one. And if you had one, maybe it was a $1,000 limit. Today, it seems like people are getting credit cards very easy, and you used to have a checkbook and you put your bank deposit in there, and every time you wrote a check, you kept track, line by line. You could see it, you could manage, Today, everything's electronic. You're paying, and it's very hard to even keep track, and sometimes you're not even thinking where the money's going. So,
and it's amazing how many applications you get in the mail, just generic. You've been pre-approved. It's a constant, isn't it?
It's a constant, and we see when you get credit card debt, it is very tough to get that debt down. So you have to be very disciplined. You have to start taking a card, maybe the one that has the least debt, and you got to pay that down along with making the other payments. And then as you get that card cleared off, you got to start working on that. But that credit card debt really hurts people in retirement.
Okay, so if you look at the big picture, you're saying, let's try to save with the 401k, the Roth, and then deal with your, save money for health care costs, and also deal with your credit card debt. So those are the things we should be focusing on.
That's correct.
And at what age should this start?
Well, I think as soon as possible, because even our younger people right now, they're getting in habits of spending and not keeping track of that. And boy, 10 years goes by pretty quick, 15 years goes by pretty quick. So just be disciplined and make a plan and stick to it.
Do you know what we forgot to mention, because it's a painful thing for me right now, is saving for college.
Oh, yeah, yeah.
Right?
Right. College expenses, another thing.
They keep going up and up, it seems like.
Up and up.
That's got to come to a stop soon, wouldn't you think?
You would think that they're going to have to do something, because where's it going to be? Eventually, it's going to be so outrageous.
Yeah, it's crazy. Okay, where can people go to learn more about you?
Well, they can go to our website at hughes-dern.com. That's our website. A lot of information on there, and you can find more information on our website.
How to do these things. Thanks so much for coming in.
Thank you very much.